Okay, let's dive in. We're going deep today, really pulling back the curtain on something that's just absolutely fundamental to trading success. But it's often misunderstood, right? Or even actively fought against.
Yeah, absolutely. We're talking about trading psychology.
Exactly, the psychology behind it all. You've shared some, well, frankly, incredible insights from a masterclass on this very topic. Stuff that delves into the mental, the emotional landscape that really separates the winners from the losers.
That's right. It's the often overlooked part. People get so focused on charts, strategies,
The technical stuff.
yeah, the mechanics. But this masterclass transcript makes it really clear. The biggest problems, they usually start before you even think about placing a trade.
Before the trade, how so?
It stems from your attitude, your ingrained beliefs, the whole psychological setup you bring to the screen. And the big question is that setup actually equipped for what trading demands?
Right.
Which is often, well, pretty counterintuitive.
Right. So our mission for this deep dive is pretty crucial, I think. We want to zero in on the most important nuggets from that material, help you, the listener, understand why mindset, emotion, discipline, why these things are just as important, maybe even more important than the strategy itself.
Couldn't agree more. It's about the inner game. Why do smart people with good strategies still struggle? What makes the consistent traders tick?
And crucially for you listening, how can you actually build a stronger mental game for your trading? We're going to distill the advice, the sometimes surprising truths from this source.
It's not just about knowing what to do theoretically. It's understanding how your brain is wired, and how to work with that wiring, or sometimes, honestly, work against it when it clashes with the market's reality.
Yeah, that wiring, the source really lays bare the biases we all have, doesn't it?
Yeah.
And how they just crash head on with the market's randomness, the uncertainty.
It's a deep dive into that exact conflict. And the value for you isn't just understanding it intellectually, it's getting actionable insights, things you can start using to address those clashes.
Okay, here's where it gets really interesting. Let's jump into the first major theme the source highlights, the foundational problem.
Right.
So, the masterclass really hammers this point. Trading problems often aren't about a bad strategy. It's the trader's mindset before they even click the mouse.
Yeah, it's the attitude, the beliefs, the biases they carry in, things that just don't mesh well with effective trading.
And the biggest factor, according to the source, it's our whole attitude towards winning and losing.
Bingo. That's the crux of it. From day one, society basically pounds into us. Winning is everything, losing is failure, shame, something to avoid like the plague. It's incredibly powerful conditioning.
You see it everywhere, don't you? The source gives that, maybe slightly cheesy, but perfect example, the high school football sign.
Oh yeah, winners never lose and losers never win.
Right, that kind of black and white thinking, it's everywhere. Success, victory, podiums, failure gets hidden or spun or just ignored.
So naturally, when you first come to trading, what's your focus?
Winning, making money, seeing green on the screen, and avoiding losses at all costs. Every red trade feels like a personal failing.
Exactly. And that mentality, that intense focus on winning and fear of losing, it plugs right into something even deeper, right? The desire for control.
Ah, control. We're wired to think effort equals results. Work hard, succeed, study hard, pass the test.
If I buy the best system, I should get the best results.
Yeah.
If I just try hard enough, use enough mind control,
Mm.
I should be able to make this trade a winner.
The market just laughs at that, doesn't it? This is where it clashes violently with our wiring. The source is stark. You cannot control the market's outcome, period.
Doesn't matter how smart you are, how much you research, how fancy your software is, you don't control where price goes next.
You control your actions, right?
Right,
Entry, exit side.
exactly. Your inputs, but the market's movement, driven by countless factors way beyond you, it has a random component you just can't eliminate.
And that lack of control, that's the big trigger, isn't it?
It flips people out, as the source puts it, because it violates our evolutionary psychology, that caveman living within you.
Our brains evolved where cause and effect were more direct for survival. Hunt, maybe get food, build shelter, get protection. Effort mattered directly.
But the market's randomness, the uncertainty, it breaks that wiring. Our brains desperately seek patterns, seek control, and the market basically says, nope, not here, not in the way you expect.
And that disconnect, that's where the psychological pain comes from, the anxiety.
It's a primary source. Your brain senses a threat, lack of control, potential loss,
Yeah.
but the usual tools, like trying harder, don't work to control the outcome. It creates this constant internal friction.
Wow. So that initial mindset, fixated on controlling wins, avoiding losses, it's actually setting you up for failure from the start.
It really is. It sets you up for frustration, emotional turmoil, bad decisions, the whole cycle.
Okay, so if that societal focus on winning and dread of losing is such a problem, what's the alternative? What do successful traders do differently? The Masterclass has this really surprising, almost backward-sounding insight here.
Yeah, this is a real pivot point. It says, the mark of a truly great, consistent trader isn't that they never lose.
Impossible anyway.
Totally impossible in a probabilistic game. No, the mark is that they are, and this is a direct quote, a damn good loser.
A damn good loser. That just sounds wrong based on how we're raised.
Exactly. It's counterintuitive.
Yeah.
But success here isn't about avoiding losses. It's about viewing them as a necessary cost of doing business, an inevitable part of the process.
So it's about managing failure well, not just chasing success.
Precisely. Becoming highly skilled at handling losses effectively, minimizing their impact, not pretending they won't happen, or trying desperately to avoid them.
The source uses a really interesting contrast from the institutional world to illustrate this. Talk up the home run hitters.
Right. So in many big firms, the culture often rewards the traders who have those spectacular years, right? Pulling in $50 million, huge numbers. They get the big bonuses, the press.
The glory.
Yeah. But here's the catch the source points out. Those home run hitters, they often don't last. 5, 7 years maybe,
Yeah.
and they're gone. Burned out, blown up.
Meanwhile,
You've got other traders, maybe quieter, just consistently grinding out profits. Maybe only $10 million a year, year after year. Those are the ones who build long, stable careers.
that the institutional culture still chases the home runs.
Often, yeah. It looks better short term, fits the winning narrative, even though they know consistency is key for longevity.
And this is where the source warns retail traders, right? Don't buy into that BS, as they call it.
Exactly. Chasing home runs in your retail account, especially when you start small,
Yeah.
it's incredibly risky. It pushes you to take way too much risk.
You might get lucky for a bit, feel invincible.
Oh yeah, get that emotional high. But then reality hits. A string of losses, market volatility, a black swan event, one of those rare, nasty surprises.
And because you're swinging for the fences?
It can wipe you out. Years of work gone, account blown. Getting rich quick is the fantasy. Surviving and being consistent. That's the professional reality.
So becoming a good loser in practice, what does that actually look like? What actions does it involve?
Very concrete things. It means don't stay in a bad trade just hoping it turns around because you want it to.
The hope trade. Deadly.
Absolutely. It means never adding more money to a losing position to average down or fix it. That's just emotional decision-making, throwing good money after bad.
And mastering that impulse, that urge to somehow save a trade that's clearly failed based on your plan.
That's huge. You have to learn to just cut it loose, accept the loss, and move on.
There's that anecdote about the trader who used to throw his keyboard.
Oh yeah, classic. That anger, that frustration about losing. It was actually fueling bad decisions. It gave him this false sense of control, like he could force the market to do what he wanted if he was just angry enough.
He had to tame the anger.
Not eliminate it, you can't really do that, but manage the behavior that came from it. Learn to accept the loss calmly, exit, and move on. Become, as the source says, an incredibly good loser.
And the example of David, the successful trader.
Perfect illustration. He gets into a trade based on his rules. Conditions change, invalidating his reason for being in the trade, even though his stock wasn't hit yet.
So what does he do?
He just calmly exits, takes a small loss. Meanwhile, others stay in, the market reverses. They make a killing on that exact same trade.
Ouch. How did he react?
No regret. His response was simple. It didn't fit my conditions, I'm out.
Wow. No backstory, no what ifs.
Nope. His edge comes from sticking to his rules over many trades. He accepts the outcome of this trade, win or lose, without getting emotionally tangled in the money he could have made by breaking his rules.
That shows how hard it is, though. Intellectually, we know small losses are okay. But when it's real money.
The emotional brain screams. That urge to avoid the pain of loss, to make it right, to not be wrong. That's what the source calls the demon.
And mastering that demon, that takes real work, not just reading about.
Serious effort, yeah. It's a deep-seated emotional battle.
Okay, so if success isn't about winning every trade, and it's really about being a disciplined, damn good loser, then what's the actual core skill that separates the pros? The source is pretty clear on this.
Crystal clear. It's risk management.
Risk management, not finding setups.
That's the surprising part. The source suggests finding opportunities, spotting patterns, even making money short-term.
Yeah.
That's actually the relatively easy part.
Easy, really?
Comparatively, yes. They even say you could teach a 10-year-old neighbor the basics of finding setups pretty quickly.
Huh. So the hard part, the thing that takes years to really master.
Is risk management. That's what defines professional longevity. Their primary job, day in and day out, is managing risk. It's not an afterthought, it's the whole game.
And how do most retail traders stack up on that front, according to the source's observations?
Well, the estimate is that a big majority, maybe over two-thirds, are essentially risk seekers,
Meaning?
meaning they're drawn primarily by the opportunity, the potential gain, the excitement. This shows up as impulsive trades, trading way too big for their account and finding it incredibly hard to take losses. All signs of poor risk management. They're focused on the upside.
Always asking how much can I make instead of how much can I lose and is that okay?
Exactly. Then you have the other group, maybe a third, who are risk-averse.
That sounds better for risk management, no?
You'd think so, but for them it's often paralyzing. They're so focused on avoiding any loss that they hesitate on good setups, or they jump out of winning trades way too early at the first tiny pullback.
Scared money cripples their ability to actually make gains.
Precisely. They're so afraid of losing, they can't win consistently.
So what does professional risk management actually involve? What are the specifics?
Quantitatively, a key thing is risking only a small percentage of your capital on any single trade. The recommendation is typically between 1.5% and 3%. The speaker in the masterclass mentioned his own are often 1.5% to 2.5%.
Seems tiny to someone chasing big wins.
It does, but it's the buffer that keeps you in the game during inevitable losing streaks. But it's not just about limiting losses.
Okay.
It's also about knowing when to prudently step up size. Not recklessly, but recognizing specific market conditions, like a strong trend day where probabilities are higher, and cautiously increasing size while still managing risk per unit.
Scaling up based on conditions, not hope.
Exactly. And a huge point the source stresses.
Oh, yeah.
You have to earn your size.
Burn it out.
By growing your account through consistent performance with smaller sizes first. Don't just dump in more money and immediately start trading bigger. That's a recipe for disaster.
Why, if the capital's there?
Because your psychological capacity to handle the swings hasn't caught up. You need to gradually increase size as your account grows organically. Move from 1 contract to 2, then 2 to 3, as performance allows.
It's a gradual process that doesn't shock your system.
Right. Trying to jump levels too fast is emotionally jarring. It sets you up for huge psychological pain during drawdowns.
The beam analogy they use is perfect here.
Oh yeah, walking a beam on the ground, easy. 3 feet up, okay. Come 5 feet, getting nervous.
50 stories, forget it unless you're trained. Same beam, different psychological pressure.
Exactly. Your capital size acts the same way. Trading a size you haven't mentally earned is like trying that beam at 50 stories with no practice.
Which reinforces that get-rich-quick mentality is just...
Totally unrealistic. It shows a lack of understanding that trading is a skill, like tennis, golf, playing an instrument. It takes practice, development, patience. There are no shortcuts to proficiency, especially in managing the mental side.
Okay, so we get it intellectually. Winning-losing mindset is flawed, risk management is key. But why is it so damn hard for most people to actually do it? Why does knowing it not translate to doing it?
Now we're getting deeper. This is where the masterclass really digs into the unseen forces. These beliefs about uncertainty, risk, winning, losing, they don't just live in your conscious thinking brain.
The part that does the analysis makes the plans.
Right. That part thinks it's in charge. But these beliefs operate at a much deeper, emotional, largely subconscious level. Your emotional brain, the limbic system, that's often running the show, especially under pressure.
The survival brain.
Exactly. It's older, faster, doesn't operate in language like your thinking brain. It's focused on quick assessments, threat or opportunity. And it triggers automatic responses, freeze, fight, flight, often before you're even consciously aware.
The source compares it to advertising research.
Yeah, compelling parallel. Advertisers know most decisions, like 95%, aren't conscious or rational. They're driven by subconscious factors, emotions, associations. That's why they study body language, eye tracking, not just what people say they want.
Because behavior reveals the deeper drivers, like that Mercedes repair cost example from the 80s.
Hilarious, but illustrates the point. Average repair, over $1,700 back then. Huge money. Was it rational? No. It was driven by a subconscious need for status, belonging,
Uh,
overriding financial logic.
and trading plugs right into these deep needs.
Absolutely. The source highlights a few core ones wired by our limbic system. The need for adequacy, the need to feel like you matter, a sense of personal worth, and that powerful aversion to feeling powerless.
These are adaptive in normal life, right? Motivate us.
Highly adapted for survival and social cohesion.
Yeah.
But in the market, which is totally indifferent to your personal needs, they become liabilities.
Trading can become a way to unconsciously try and prove yourself, prove you matter, get that sense of power.
For some, yes. And this links to that pattern the source mentions. Traders building their account up to a certain point, say 50K and 100K, whatever their internal thermostat is set to,
And then they lose it back down.
time and again. It's like a subconscious belief about their own worth or comfort level kicks in. They sabotage themselves, often by taking crazy risks when they hit that internal ceiling.
Wow. So the trading account is like a truth meter.
That's exactly what the source calls it. Brutally honest. It shows you your real operative beliefs about handling uncertainty, not just the ones you think you have.
If you look at your results and behavior like a detective,
You'll see the patterns tied to these core needs, these subconscious drivers. Your equity curve reflects you as a decision maker under pressure.
which leads right into another big theme, trading as a path to self-growth, not just about money.
Absolutely. It becomes this powerful vehicle for personal development, precisely because it forces you to confront and learn to tolerate intense psychological discomfort.
Things our wiring hates, like waiting patiently for a setup when you want action now.
Or the agony of being in a trade that's stalling or going against you. The easy emotional out is just to close it.
Or taking that planned small loss, then watching it rip in your original direction. Painful.
Oh, yeah. Or missing a great trade because you hesitated. That FOMO, fear of missing out, that's a huge discomfort.
Our brains just aren't built to easily tolerate losing, being wrong, missing out. It triggers alarms.
So learning to sit with that discomfort, to manage it, and act according to your plan anyway, that requires real growth, conscious effort to override those primal reactions.
Trading becomes a tool for self-discovery then, understanding who I am under pressure.
Exactly. The source says you can only trade like yourself, your unique mix, but the journey is about becoming the best version of you as a trader.
Which involves learning to separate real intuition from just raw emotion.
Crucial distinction. Intuition comes from experience, screen time. Emotion, fear, greed is usually reactive and destructive.
And when capital's on the line, the survival brain is protecting not just money, but ego, self-worth.
They get all tangled up, especially in our culture. So tolerating those market assaults on our ego, being wrong, losing money that takes, as the source says, real effort and some really deep work.
Now, here's something the source says is a real eye-opener for retail traders about emotions.
Yeah, this is huge. Successful professional traders, they feel the exact same emotions as struggling retail traders.
They feel the anxiety, the frustration, the FOMO.
All of it. They're not robots. The critical difference isn't what they feel, it's how they react behaviorally when those feelings pop up.
So if you're listening and you feel that stress, that regret, it doesn't mean you're broken or not cut out for this.
Absolutely not. You're not defective for having FOMO.
Yeah.
The best traders feel it too. They've just learned, through hard work, not to let that feeling dictate impulsive actions that violate their plan.
They feel the fear, but don't let it drive the bus.
That's a good way to put it. Emotion is natural. It directs attention. You can't and shouldn't try to eliminate it. Trying to suppress it actually makes it stronger, that paradox in psychology.
The mind, as a sentinel, bringing your attention to what you resist.
Right. So feeling is normal. The skill is in observing it and responding effectively, not being controlled by it or trying to pretend it's not there.
Okay, given how deep this stuff runs, how challenging the market is psychologically, the Masterclass offers practical tools, right? Things you can actually do to improve your mental game.
Yes, definitely. These aren't magic fixes, but disciplines that build mental muscle over time. First one, maybe obvious, but crucial. Practice.
Practice, like just trading more.
Not just live trading. That's performance. Like an athlete, you need dedicated practice away from the pressure of real money, specifically focused on skill and psychological resilience.
I don't know.
Use historical data, bar replay software, simulate conditions, practice executing your plan without the emotional noise.
But people say it's not the same without real money.
And the source hits that head on.
Yeah.
If you let that thought stop you from practicing, you're letting your thoughts sabotage good habits.
Yeah.
That's the exact problem you need to fix. Practice builds the skills, period. They will translate.
Okay, good point. What else? Journaling.
Yes, but a performance-focused journal.
Hmm.
Go beyond just P&L and win rates. Focus on your behavior. Ask 3 questions after each day or trade.
1. What did I do well?
2. Where did I fall short of my plan or best behavior?
And 3. What concrete step can I take to stop falling short or start improving that specific thing?
This isn't just record keeping. It helps you spot your recurring behavioral patterns. Hesitating, canceling stops, chasing trades, exiting winners too soon. Once you see the pattern clearly, you can target it.
Makes sense. Then there's mindfulness and meditation.
Hugely powerful tools, the source emphasizes. For trading and life, they teach you fundamental things about your own mind.
Like what?
Like thoughts just come and go. They're temporary, not necessarily facts. Especially when you're stressed, your thinking gets skewed. And feelings like fear. They're natural survival tools. Everyone has them.
How does that help in trading?
It helps you recognize a thought, this might lose, or a feeling, anxiety, without automatically believing it or acting on it like a command. This is key for deconditioning fear responses.
Deconditioning fear, like Pavlov's dogs.
Exactly like that. Painful losses can condition you. Seeing a setup can start to trigger anxiety automatically, even if the setup is good. You associate the potential for loss with the act of trading.
And trying to just push through the fear doesn't work.
It usually makes it stronger. Remember the sentinel mind. It flags what you resist.
So the mindful approach is
Notice the thought. Fear of lost thought. Notice the feeling, okay, anxiety in my chest. Acknowledge them without judgment. See them as temporary events. Then you can choose to act based on your plan, not the fear. Create space between stimulus and response.
that takes practice.
A lot of practice. What about pattern interrupts?
Simple techniques to break a negative cycle just before it happens. The classic example is the rubber band snap.
Right. You feel that familiar urge about to cancel a stop, about to chase a market, then have the band on your wrist.
The little sting isn't punishment.
It's an interrupt. It breaks the trance, creates a moment of awareness. Whoa, I'm about to do that thing again. Gives you a split second to choose differently.
Visualization is another one.
Yes, but used correctly away from the live market as preparation. You vividly imagine a high-stress scenario. You struggle with markets screaming towards your stop, maybe. Intentionally feel the physical stress, breathing fast, muscles tight. Then consciously change your state. Slow your breathing, relax your body. While calm, visualize yourself taking the correct planned action, letting the stop get hit calmly, or scaling out properly.
Rehearsing the desired response while calm.
Exactly. Doing this repeatedly can rewire your response when the real stress hits.
And finally, self-talk.
Can be useful, but the source notes it's very personal. What works for one person might not work for another.
The speaker gave his own example, right? Pretty harsh stuff.
Yeah, he used aggressive, almost abusive self-talk to stop himself from taking profits too early, calling himself an idiot, asking if he was stupid. For him, that anger created determination.
Might not work for everyone.
Definitely not.
Right.
But the principle is finding your way to use internal dialogue to challenge bad impulses and reinforce disciplined behavior. Use your inner voice strategically.
Okay, so putting all this together, it leads to seeing the market and your role in it differently, right? The source says acting like a good, normal, sane person often fails in trading.
Yeah, because the market isn't a normal, rational environment like, say, your workplace or family life. It has this pathological quality. It seems almost designed to exploit our biases and emotions.
What feels instinctively right based on normal life is often wrong in the market.
Precisely. The market encodes human emotion, fear, greed, hope, panic, and a price. It's like a war of emotions, and it pushes your buttons at the worst possible times, turning your own mind against you.
Which leads to that difficult idea. Go into your fears.
Right. The areas causing you the most pain or anxiety in trading. Taking losses, holding winners, whatever it is, that's often exactly where you need to focus your work. The fear is a beacon.
Counterintuitive again. Normally, pain means move away.
But here, leaning into the discomfort, exploring its roots, that's the path to growth. And the source notes, the raw intensity does lessen over time.
The market punches you in the face enough times.
Yeah, you learn through exposure, build psychological callus, and journaling helps pinpoint your specific fear triggers so you can work on them.
Now, what about that controversial 1R profit target idea? Taking profits when your gain equals your initial risk.
Fascinating stuff. The speaker initially thought it was the stupidest idea, completely against let your winners run.
But the backtesting showed something different. 200 hours of it.
Surprisingly different. The 1R strategy resulted in a much smoother equity curve. Less volatility, fewer big drawdowns.
Okay, smoother is good psychologically,
Yeah,
but did it make less money overall?
that was the shocker. In this test, over that period, it actually resulted in higher ending equity than the strategies aiming for huge wins or using trailing stops.
Wow, how is that possible?
The thinking is, while those huge wins, 10R, 15R, are great when they happen, they're rare. The consistency of smaller 1R wins, coupled with the smoother equity curve, allowing maybe slightly more leverage or just better psychological endurance through drawdowns, it added up to more over time in this specific test.
Needs testing for individual strategies, obviously, but it challenges the home run bias.
Absolutely. It suggests maybe consistent base hits are better than always swinging for the fences, especially from a risk and psychological management perspective, survival and compounding.
And this ties into identifying your personal triggers, right?
So,
Not just general concepts.
critical step. You need to map your emotional patterns. What are the subtle signs, the data points that signal you are about to make your common mistake?
Like the client who realized checking his open P&L too often was his first step towards greed.
Perfect example. It wasn't the big mistake itself, but that small, seemingly harmless action. That was his tell. Recognizing that allowed him to catch himself earlier.
So if you know you tend to chase rallies when you're in a drawdown,
You prepare. Before the day starts, or when you see that setup forming, you consciously tell yourself, okay, danger zone. Sit on your hands until you get clear confirmation per the rules. That mindful preparation is progress.
and finally, framing it all as a long game. This is huge.
Absolutely essential. Trading is a campaign over many, many trades, not just today's win or loss. A single trade is just one probabilistic event.
Like one play in a game, not the whole game.
Exactly. Your edge only shows up over dozens, hundreds, maybe thousands of trades. You need 60, 90, 180 days or more to really see if it's working.
So checking that intraday P&L constantly.
Often totally irrelevant strategically,
Yeah.
unless it informs a planned adjustment. If it just makes you feel good or bad, or tempts you to mess with the trade emotionally, it's counterproductive. Zoom out. Focus on the process, the long series.
Okay, let's try to wrap this up. Our deep dive into this masterclass. It makes it so clear that trading success is way more than charts. It's mastering your internal game.
Yeah, understanding and changing that win-loss mindset. Prioritizing risk management, like a pro. Becoming that damn good loser.
Recognizing the power of the emotional brain, those core needs, and using your account as that truth meter.
And seeing trading as this demanding, but potentially rewarding, path for self-growth. Using tools like practice, journaling, mindfulness, pattern interrupts, visualization.
To navigate the market's weirdness and condition yourself for consistency. And maybe, just maybe, realizing that consistent smaller wins might beat chasing home runs.
It's a challenging journey, no doubt. Self-discovery, behavioral change. The market constantly pushes your buttons, challenges your beliefs, triggers your fears.
Professional traders feel it too, but they respond differently. That's the learned skill.
It takes real self-awareness, real effort, willingness to face the uncomfortable stuff.
So here's a final thought to chew on. Given how deep our emotional wiring goes and how the market seems almost purpose-built to exploit it, could it be that the greatest trading edge you can ever find isn't on a chart or in an algorithm?
But maybe it's in your own capacity for self-awareness, for disciplined emotional management, for consistently doing the right thing according to your plan, even when, especially when, it feels completely wrong.
Is that the ultimate edge, something to definitely consider as you continue your own journey?